All right, so good evening to everyone. So we're group 5 and we'll be presenting about financial regulators. So first, financial regulators. What do they do? Who they are? Federal and state government have myriad of agencies in place that regulate and oversees financial markets and companies. Although opinions vary on the efficiency, effectiveness, and even the need for some of these agencies, they were each designed with specific goals and will most likely be around for some time. So these financial regulators, they have their own specific tasks, and because they have their own specific tasks, they normally work independently. All right. The Fed Reserve Board. The Federal Reserve Board, or FRB, is one of the most recognized of all the regulatory bodies. Often gets blamed for economic downfalls or heralded for stimulating the economy. The board also supervises and regulates the banking system to provide overall stability to the financial system. Moreover, one of the key regulatory roles of the FRB is to oversee the commercial banking centers in the US. Most national banks must be members of the Federal Reserve System. However, they are regulated by the Office of the Controller of the Currency. The Federal Reserve supervises and regulates many large banking institutions because it is the federal regulator for bank holding companies.
For Office of the Comptroller of Currency, OCC was established during the year 1863 and known as one of the oldest federal agencies. The OCC manages and provides charters to banks operating in the United States to ensure competency within the overall banking system. With OCC, banks are able to compete with efficient banking and financial services. So, what does OCC do? It issues bank rules and regulations on a bank's corporate decisions. Visiting and examining the bank it oversees, evaluate applications for new bank charters or branches, impose corrective measures when necessary, and protect consumers by ensuring the fairness of banks with access and treatment to customers. Next slide, please. Now, for Federal Deposit Insurance Corporation, or FDIC, it was created in order to ensure deposits and guarantee the safety of funds. Insurance corporation that covers benefit plans for different types of accounts like joint accounts, revocable and irrevocable trust accounts, and employee benefits. The insurance that FDIC offers does not cover all products. These are the mutual funds, annu- annuities, life insurance policies, stocks, or bonds. And in the Philippines, the counterpart of FDIC is PDIC, or Philippine Deposit Insurance Corporation, which gives out the same purpose. Next slide, please. Now, for Office of Thrift Supervision, through financial institutions, Reform, Recovery, and Enforcement Act of 1989, the Office of Thrift Supervision was established in order to issue and enforce regulations governing the nation's savings and loans industry. It was abolished in the year 2011 since OTS merged with other agencies like the OCC, FDIC, and the Fed Reserve Board, and also CPFB. FB.
So for Commodity Futures Trading Commission, the Commodity Future Trading Commission was created in 1974 as an independent authority to regulate commodity futures, options, and other related derivatives markets, and to provide for competitive and efficient market trading. The CFTC has evolved since 1974, and in 2000, the Commodity Futures Modernization Act of 2000 was passed. This changed the landscape of the agency by creating a joint process with the Securities and Exchange Commission to regulate single stock futures.
Next, we have the Financial Industry Regulatory Authority, or the FINRA. So the FINRA was created in 2007 from its predecessor, the National Association of Securities and Dealers, or the NASD, as a self-regulatory organization, or SRO, as an outcome of the 1934 Securities and Exchange Act. So the FINRA, it oversees all firms dealing with securities with the public and handles the training and licensing of professional agents. Next, we have the state bank regulators, or state and the state insurance regulators. So these operate similarly to the OCC and work with the FDIC and Federal Reserve. In the Philippines, we have its counterpart. This would be the BSP, or the Bangko Sentral ng Pilipinas, and the Philippine Deposit Insurance Corporation, or the PDIC. So the Philippines also has its own insurance commission that oversees and handles all proceedings pertaining to insurance services. Next, we have state securities regulators and the SEC. So the state securities regulators augment and consolidate the functions of the FINRA and the SEC to pertain to the regulation of securities in a particular state. The Philippines has its own Securities and Exchange Commission that handles all securities proceedings in the country. And unlike the United States, the Philippines' own SEC is a branch of its own government and does not function independently of it.
The SEC can work together with the Department of Justice to provide evidence and assist with court proceedings. However, this does not mean they have full jurisdiction of criminal cases. SEC can only bring civil actions under federal court and administrative judge. Next slide, please. In essence, the aforementioned government agencies pays close attention to people in the different industries they participate in. Federal agencies may replace state agencies, but it does not mean state agencies are any weaker since they have comprehensive responsibilities.
So in conclusion, having government regulators is important in protecting the welfare of people involved in banking, securities, and insurance. These regulators provide a system to avoid having a party to take advantage of another. And lastly, without regulators in a country, there will be no stability and uniformity in the banking system. So thank you all for listening.